Hi everyone, welcome back to Corporate Decoder. Today we're digging into semi-annual shareholder reports that might make your eyes glaze over but hold some juicy financial secrets. This report from Delaware Group Limited Term Government Funds, which is now part of Macquarie, they do these regular updates for their investors, detailing exactly where their money is going. It's a peek under the hood of a specific type of investment called a mutual fund. Let's dive right into the costs you might incur as an investor. For example, if you put $10,000 into Class A shares, your costs for that 6-month period were about $32, representing a little over 0.5%. Now, if you went with Class C shares, those costs jumped to $70, almost 1.5%. This tells you directly that different share classes come with different price tags for managing your money. It's a simple but important distinction for any investor. The total net assets for the fund are a hefty $698 million. That's a lot of money being managed. It also tells us that the fund is holding on to 307 different investments. Think of it like a basket holding 307 different kinds of fruit. But in this case, it's financial assets. Looking at how the money is actually invested, the biggest slice, or about 31%, is in US Treasury obligations. These are basically loans to the US government, generally considered very safe investments. Following that, around 30% is in corporate bonds. These are like loans you make to companies. The higher the percentage here, the more the fund is betting on companies doing well financially. Then comes non-agency asset-backed securities at over 19%. These are financial products made by bundling together things like car loans or credit card debt. It's a bit more complex, and the non-agency part means they aren't backed by the government in the same way as something like a US Treasury security. Now for the really granular part, the schedule of investments in the Macquarie Limited Term Diversified Income Fund. This is where you see the specific companies and government entities whose debt the fund is holding. Here we see an example of an agency collateralized mortgage obligation, specifically a Fannie Mae security with a coupon rate of 7% maturing in 2041. When you see these government-backed mortgage securities, it means the fund is invested in bundles of mortgages that are guaranteed by government entities, which are generally considered stable. This is an agency commercial mortgage-backed security. That means it's backed by mortgages on commercial properties like office buildings or shopping malls. The 144A designation means it's a private placement, not traded on public exchanges, which often means it's less liquid but can sometimes offer higher yields. The SOFR plus a spread indicates it's a variable rate security, meaning its interest payments can change over time based on a benchmark rate. This entry shows a corporate bond from Bank of America, a major bank, with an interest rate of 5.8119% maturing in 2029. Holdings like these in large, well-known companies are common in bond funds. Another corporate bond, this time from Goldman Sachs, a leading investment bank, the fact that it's tied to SOFR, the secured overnight financing rate, means its interest payments will adjust with market rates. This is a key indicator of how the fund is positioned in relation to potential interest rate changes. Across all corporate bonds, the fund spent over $2110 million. This is a significant chunk of its total investment, showing a clear strategy of betting on corporate debt for returns. Here you can see an investment in United Airlines, a major US airline, with a 4.375% interest rate maturing in 2026. Airlines, like many service-based industries, can be sensitive to economic cycles, so seeing how much the fund invests in them gives you a clue about its risk tolerance. This is an example of a municipal bond specifically from Puerto Rico's sales tax financing revenue. These are often held by tax-exempt funds because the interest earned is typically exempt from federal income tax, and in some cases state and local taxes too. It's important to note that Puerto Rico's financial situation historically has had its challenges, so investments here might carry slightly different risks compared to those from a US state. This bond is from the state of Oregon with a 5.25% coupon rate due in 2050. Oregon has generally been fiscally sound, so state-issued bonds are usually seen as a relatively stable part of a municipal bond portfolio. Let's look at the fund's overall financial position. Its investments are valued at nearly $60.95 million. Then you have cash of about $110,000 plus some cash collateral due from brokers, which is money held by brokers to back up transactions. Receivable for securities sold is about $71 million. This represents money the fund is owed from sales of investments that haven't settled yet. It's like having money expected but not yet received in your bank account. The fund's total liabilities are around $75 million. This includes things like money owed for investments it has bought but hasn't paid for yet, and also accrued expenses like management fees it needs to pay. Now, the bottom line, the fund's total net assets stand at almost $700 million. This is the actual value of the fund after all its assets are counted and its debts are subtracted. This section shows where the fund's money came from and where it went over the last 6 months. Investment income, primarily from interest earned on its holdings, brought in over $15.9 million. Expenses are detailed here, with management fees alone being close to $1.8 million. Then there are various other fees for things like administration, legal services, and keeping shareholders informed. After accounting for all income and expenses, the fund's net investment income for the period was about $14.3 million. This is the profit generated from its core investment activities, before accounting for gains or losses on the investments themselves. Looking at realized gains and losses, the fund had a net loss of about $91,000 from selling investments. They also had a loss of over $1.2 million from futures contracts, but a gain on swap contracts. So in total, they had a net realized loss of about $2 million. On the flip side, the fund saw a significant pickup in unrealized appreciation on its investments, meaning the value of assets it still holds increased by over $7.7 million. This is the potential profit from investments that haven't been sold yet. Combining all these, the fund's net realized and unrealized gain for the 6 months was about $5.5 million, contributing to an overall increase in net assets from operations of just under $20 million. If we focus on the financial highlights for Class A shares, the net asset value at the start of the period was $7.86 per share and ended at $7.92. This is a modest gain. The total return, which includes reinvested dividends, was about 2.76% for that period. This is a decent return, especially in a potentially challenging market. The expense ratio for Class A shares, the cost of running the fund relative to its assets, was 0.64%. This is a key number for investors to watch as higher expenses eat into your returns. And the ratio of net investment income to average net assets, which shows how much income the fund generated relative to its size, was 3.94%. This gives you a sense of the fund's earning power from its investments. Now let's quickly check Class C shares. It's important to see how the different classes perform and cost. The net asset value per share for Class C ended at $7.92, same as Class A, but remember Class C shares typically have higher ongoing expenses. And look, the expense ratio for Class C is 1.39%, almost double that of Class A. This reinforces that those high distributions or fees common with Class C shares add up and directly reduce your investment's growth. Let's switch gears to the Macquarie Tax-Free Oregon Fund. As the name suggests, this fund focuses on municipal bonds, aiming to provide income that's generally free from federal taxes, and often state and local ones too, particularly for residents of Oregon. Looking at its investments, about 24% is in local general obligation bonds. These are bonds backed by the general taxing power of local governments. Then you have special tax revenue bonds at over 16%. These are backed by specific revenue streams, like tolls from a bridge or fees from a particular service rather than the general tax base. The geographic concentration is very clear here. Over 81% of the fund's investments are focused in Oregon. This means the fund's performance is heavily tied to the economic health and fiscal policies of that particular state. Digging into the specifics, we see various municipal bonds, for example, Oregon State Facilities Authority revenue bonds and City of Eugene Electric Utility System revenue bonds. These are all forms of debt issued by state or local entities. This entry shows a bond from the City of Eugene, Oregon, with a 5% yield maturing in 2049. Investing in municipal bonds like these can be attractive for tax purposes, but it's important to understand the credit quality of the issuing municipality. This bond from the City of Newport, Oregon, has a remarkably high 12.11% interest rate. The AGGEN probably signifies that it's insured by assured guarantee, a common practice to enhance the credit rating of municipal bonds. However, such high rates can sometimes signal higher risk or come with specific tax implications, like being subject to alternative minimum tax. Here we see investments in Puerto Rico revenue bonds. Puerto Rico has faced significant financial challenges in recent years, so bonds issued by the Commonwealth or its entities are generally considered to carry higher credit risk compared to bonds from US states. This highlights the importance of researching the specific issuer's financial health. The Macquarie Tax-Free Oregon Fund has total net assets of about $50.7 million. Its investments are valued at a little over $50 million. Interest receivable is around $564,000. This is like earned income that hasn't been paid out to the fund yet. For this fund, the investment income generated from interest was about $1.15 million. The expenses, including management fees, were around $276,000. The net investment income for the period was close to $959,000. However, when we look at realized and unrealized losses on investments, the fund experienced a significant drop, ending the period with a net increase in assets from operations of negative $1.25 million. The fund had a realized loss on investments of about $830,000 and an unrealized loss on investments of nearly $1.4 million. This means the value of the investments it holds has decreased. Interestingly, there's a small positive number here for net increase from payment by affiliates, which might indicate some sort of reimbursement or correction from the fund's management company. It's a minor amount, but it's worth noting the intercompany dealings. So overall, this filing shows two different types of mutual funds. The limited term diversified income fund seems to be navigating the market with modest gains and a relatively stable investment mix, focusing heavily on government and corporate debt. However, the tax-free Oregon Fund is facing headwinds, with its municipal bond focus leading to larger realized and unrealized losses in this period, likely due to market conditions affecting municipal debt and potentially specific issues related to its concentration in certain issuers like Puerto Rico. For investors, the key takeaway here is the impact of credit quality and geographic concentration on fund performance, especially in less stable markets. Always check those expense ratios and understand where your money is being invested. What's your take on these numbers and what they signal for the future of these funds? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up, subscribe for more deep dives into corporate finance, and join our Discord community for even more discussions. Thanks for watching. See you next time.